Fixed rate mortgages, standard variable, tracker, capped and collar, offset, discount, it can be so confusing. I only understand the different types because I deal with them every day. In this video, I'll go through each of those rates I listed there, along with one pro and one con for each of them. Hi, if we haven't met before, my name's Dan and I'm a CeMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or recommendation to act. And I must stress, as a mortgage is secured against your home, it could be repossessed if you do not keep up with the mortgage repayments. With that out of the way, on with the video. There are multiple pros and cons for each of the rates, but I don't want to overwhelm you. Fixed rate. It does exactly what it says on the tin. You are fixed in for a period of time. Most fixed rates are over 2, 3 or 5 years, but some are over 10 years, but they're not as common. So you fix in for a period of time. For example, with a 2-year fix, your rate does not change over the 2 years. So therefore your monthly payments do not change. A pro with a fixed rate is peace of mind of knowing what your monthly payment is going to be. A con is you're tied in for a period of time. To quickly elaborate on that, there are early repayment charges. For example, on a 2-year fixed rate, there could be a 2% penalty in the first year and a 1% penalty in the second year. If you were looking to move property, because for example, you've unfortunately broken up with your partner, to pay off that mortgage, you would likely have an early repayment charge. You do get some mortgages with no early repayment charges. You might be able to port that mortgage across to the new property. If you did decide you didn't want to do this and you wanted to clear the mortgage, then you're likely to have to pay a penalty. Tracker rates. These tend to follow the Bank of England's base rate. It means your monthly payment could go up or it could go down, along with the interest rate which moves in line with the Bank of England's base rate, or whatever rate it is linked to. A pro is it can save you a lot of money if the rate dramatically drops. A con is if rates go up or we have a hostile economy, then your payments can go up. So it's really important to budget. With some tracker products, they have early repayment charges. Standard variable rate. I read that there is a huge portion of people on the standard variable rate, mainly for two reasons. You have people who have come out of their introductory rate and fallen onto the lender's standard variable rate, which can on occasions be more than double the introductory rate. The other reason is unfortunately sometimes people can become mortgage prisoners through changes of their circumstances. Something I will say is approach your existing lender and see if you can do a product transfer, or speak to a qualified advisor like myself to find out your best options. If your lender doesn't offer product transfers, then you will need to speak to a mortgage professional to get some advice. A pro is you have flexibility. You could pay this mortgage off whenever you wanted to without having to pay an early repayment charge. So if you think you're going to inherit a large sum of money and you wanted to clear the mortgage, then a standard variable rate might be ideal for you. A con is your rates can go up and who knows what your monthly payment will be. If rates continue to increase, your payments could become unaffordable. Offset mortgages. What is an offset mortgage? If you borrowed, as an example, £100,000 and you receive a lump sum of £20,000, you put this into your current account and you offset the savings against your mortgage. So if you've reduced your balance to £80,000, you will only pay interest on the £80,000. Most mortgages allow you to repay back some of the mortgage early anyway. This is usually no more than 10% per annum. But an offset mortgage allows you to make more than the 10%. So if you worked for an employer and you receive a huge Christmas bonus, you could deposit this into your offset account to lower your mortgage balance. But if you needed to access that money, for example, to pay for a new boiler, then you're able to do so. If you're liking the content so far and you think that others will find this helpful, please press the like button down below. It tells YouTube to show this video to more people. If you're on a mobile, you'll need to rotate it to portrait. Discount mortgages. What is a discount mortgage? This is where you're on lender standard variable rate. It's set at 5%, for example, but they offer you a discount of 2% for the first 2 years, making your interest rate 3%. It's great to begin with. It's ideal for those who want low outgoings initially. At the time of recording, having a discount rate is no more beneficial than having a fixed or tracker rate, but a discount rate often or not can save you money to begin with. Something you need to be wary of is rates can go up at any given time. So although you've gone from 5% to 3%, if the lender puts their rates up, you may no longer be paying 3%. You could, as an example, be paying 3.5%. So it may have been cheaper to fix the rate to begin with. A pro is you can have cheaper outgoings in the beginning, and a con is rates can rise, making it out to be more expensive. Last but not least, capped and collar. What is a capped and collar mortgage? So similar to discount rates, at the time of recording, these aren't as popular as fixed or tracker rates. A cap is where the lender will state the maximum the rate can go to, and the collar is the floor, so the lowest the rate will go to. A pro is if the interest rates are at the lowest, then it can be one of the cheapest mortgages in the market. A con is that if rates go up, like I've mentioned with other variable rates, then they can work out to be more expensive. One thing I want to stress is do not just look at the interest rate. A lot of people make this mistake, but there's more to a mortgage than the interest rate. You've got to look at the product fees, any valuation fees, and are there legal or application fees. It's all well and good seeing an interest rate for 1%, but if the product fee is £1,500 and there's a valuation and legal costs, then it could be cheaper to take the 1.2% with free valuation and legals. So this is where a mortgage advisor can be helpful. Watch this video to find other ways a mortgage advisor can help you. Remember, as a mortgage is secured against your home, it could be repossessed if you do not keep up with the mortgage repayments. To avoid making the 10 most common mistakes when buying a home, watch this video. If you found this video helpful and you wish to buy me a coffee, I've put a link in the description below. But even more importantly, if you need my help, please contact me. Thank you very much for watching, and I'll see you next week.